Alok, and welcome to our this month's discussion on market views. It's been a volatile last 4 months with Trump tariffs, with geopolitical risks, FI selling in the first 3 months, and then April FI buying, and the markets going up almost 5%. So here are a lot of fears. There are a lot of uncertainties. People are looking for clues across the board. So we have Alok and Hiren today to answer a lot of our queries that investors have. Alok, if I can start with you, uh, given that there has been a lot of tariffs imposed across different countries, there are geopolitical risks. We saw the FI selling and then coming back in April. Uh, People are looking for clues on sector leaderships, on what has changed. Are there new sectors that they should be looking at? In your view and in your quantitative analysis, have you come across any clues or any indications on change in leadership happening across the markets?
Yeah, some of them. Let's go back a bit in the history. 5 years ago, we were hit by COVID. And ever since then, most of the countries, we realized that a lot of supply chain issues need to be resolved. Major structural change happened since then. If we compare from about 2019 end till about 2024 end, the financials weightage in Indian markets, they went down from around 37.5 to about 28.5, a quarter of the weightage gone. And the major gainer was cyclicals led by the industrials, whose weightage increased from 6.2 till about 11.3. So that was a major change. But ever since the end of 24, when we started witnessing some slowdown in Indian growth and the geopolitical tensions rising and the fear of tariff wars coming through, there was some profit booking in this trade, wherein there was revival of the financials and there was some profit taking in the industrials. Within financials also, we witnessed one more interesting trend, that instead of the lenders leading the way, it was the other financial services like capital markets leading the way. So while that 5 year kind of gain of industrials versus the financials is kind of broken for the short term, but this could be a short term blip in an otherwise longer structural story, given the fact that India is resolved to increase the share of manufacturing in the contribution to the GDP. So we do think that there's longer role of cyclicals and industrials to be seen. Let's wait for another 1 or 2 quarters for numbers to unfold so that we become far more clearer as to whether this short-term trend is the one that will be lasting or we go back to industrials leading the way.
Very interesting. So, financialization of savings is clearly paving the way for financial companies other than banks.
Yeah.
And industrial cyclicals, we still remain positive. We would
True.
watch out in the near term.
On the same question, as Alok alluded, that the longer term trend that we've seen from 19 to 24, and which we've been talking about for a long time, which changed the leadership across sectors. But every change in leadership, typically, as we've seen, at least in the previous cycles, that these changes are very long term. But within that long term trend, there can always be some reversals that can happen for a short period of time, right? And as Alok said, that post middle of last year, we saw that there was a slowdown in capex spending, and then we had all these tariff issues and problems, and we saw the cyclicals basically receding a little bit, and looked like that financials are probably gaining share again. But within financial, it was more the capital markets, right? But what happens in the short run is that there are several events where narratives keep changing. So not long ago, along with the cyclicals, if you remember, even defense stocks corrected very significantly.
True.
But if you see the last few months, the defense index is probably one of the best performing indexes.
Absolutely.
Right? And you could say that, this is because of the geopolitical tensions between India and Pakistan. But for whatever it is worth, if indeed cyclicals were receding, then, defense would not have made such a great comeback. And we've seen that, again, there was momentum in order books. So these narratives in the short run can keep changing. But typically, these long-term trends do not reverse so easily. Having said that, we will keep an eye out, and hopefully, this is just a pause in the long-term structural story that we've seen, where manufacturing and cyclicals have done well. In fact, I do believe that because of what we are seeing in terms of the tariffs, uh, this, I believe, is going to give an even greater impetus to opportunities in several sectors in India to become an increasing part of the global supply chain, probably at the cost of China. And therefore, I still believe that the manufacturing story is kicking and alive.
In fact, that was what I had in mind to ask you next also. That if we look at the tariffs, Trump did announce a 26% and then went back to the base tariffs. Do you think the global trade dynamics would change from here on? And how do you think India is placed to take advantage of this?
So I think obviously when the tariffs were first announced on April 2, uh, the world was in a shock because I don't think anybody expected the extent of the tariffs that would be put. And thereafter, we saw a significant escalation between tariffs, especially between the US and China. Now, even if you go back to the April 2, tariffs, as we have said before, India was actually at the middle of the pack at 26%. Really, the tariffs were designed, uh, against China and maybe some of the other countries that China was using as a manufacturing base, like Vietnam, Cambodia, etc. But thereafter, I think that the bond markets actually forced the hand of President Trump to kind of retrace back some of those tariffs, right? So we started to see some exemptions being given out because while we all understand the objective that they want to get manufacturing back to the US, but you can't reverse 30, 40 years of globalization and supply chains overnight. So, to answer your question, is it going to change things? I think yes. In the long run, I think with what President Trump has done, it has clearly shown its hand. Now, obviously, there are certain practical issues, right? Because, you know, there is going to be a collateral impact. If you take tariffs levels so high, on the other hand, you'll have inflation going up. And that's exactly what the bond markets were telling you. So I think that there will be a change, but that underlying change will take a lot of time, right? And I do believe that uh, people will certainly think about diversifying their supply chains. And I genuinely believe that India has a great opportunity uh, to increasingly become part of the global supply chains. And if you also see the market response post the tariffs, right? I think India was the first market which actually clawed back and went above the April 2 levels. And even till date, despite the geopolitical tensions that we've seen amongst the emerging markets, India is still far better off. So India is looked at very favorably because external trade or exports is not a very large part of our economy. That's point number one. And point number two, I think the world perceives that actually India might be a net beneficiary of something like this. Also, there was a little bit of confidence that came in the Indian markets because clearly, several senior members of the Trump administration, including President Trump, has said that probably India could be the first country with whom the US could potentially sign a trade deal, right? So I think we are very well placed in relative terms. And therefore, while there will be long-term shifts in trade and supply chain, but it will be gradual, and it will take years for these, trade and supply chains to change, because nothing can happen overnight. These are long-term investment calls that companies around the world have to take. But I certainly believe that India has a fairly good chance.
So interesting. As we've been saying, even in our last video, that some of these tariffs would basically push manufacturing across different countries, one of them being India. And going forward, maybe in the longer term, India could be a net beneficiary because of these. But then that brings another question to mind, which is a very recent, event, which is more on the geopolitical tensions between India and Pakistan. Have you been able to check data, historically, and how have market reacted to such events in the past?
So going back into history, the Indian markets have reacted to these kind of terror attacks or military escalations in terms of some short-term declines. And this has led by risk aversion, FPI outflows. But one more interesting fact has been the markets have rebounded pretty soon. The cuts have generally not been deep until unless it really escalates into a prolonged war-like situation. If we take the last few, in 2019, we had this Pulwama attack, and thereafter India responded with this strike in Balakot. So the total decline there was over a few days by about 2 percentage points.
Interesting.
Once things settled down, markets actually rebounded 9-10% over the next 2-3 months. So that's the kind of response. Similar thing we saw during the Uri attack and the surgical strikes. Similar thing happened. That was in 2016. Very small decline on that day, 0.4% or so. Few more days of decline, marginal. But once things settled down, markets responded well. But we also need to see in 1999, we had a prolonged war-like situation, which was a Kargil war. During that time, which lasted close to 3 months or so, the total decline was 12%. Once things settled, the markets rebounded pretty well. So what we need to focus in the current juncture is, if the escalations are limited, the market's correction would also be limited. But in case it escalates into a war-like situation, that's when the corrections could be slightly deeper. But going by historical context, that could actually serve as an opportunity to add, invest disproportionately.
Interesting. So near-term risk, long-term opportunity.
Absolutely.
Interesting. Hiren, you run a very concentrated 12 stock portfolio. Would you be taking advantage of these situations to add to your positions, or would you be changing your positioning within the portfolio?
So again, I mean, these are very episodic events, as Alok mentioned, that it will really depend on what kind of military action India takes. If you look at what steps India has taken so far, it has chosen not immediately to take any kinetic action, but rather take a series of steps diplomatically, on the trade and economic front, and therefore India is today using far more sophisticated tools and strategies to counter Pakistan. Having said that, I mean, the military option is always on the table, and frankly, I'm not a geopolitical expert to say whether something will happen or not. There is an overwhelming emotion that obviously is there within the nation, because in the past, this government is seen to be very proactive, and therefore there is this lingering fear in the markets that there will be some military action that could potentially happen. Now, the question is that whether is it a short affair or whether something like this can escalate. That's the uncertainty for which I don't think any one of us has an answer.
True.
But I guess, I mean, if you go back again in history, right, unless we have a very, very long, prolonged war, uh, obviously there is a cost to pay, both in terms of human lives and an economic cost. So we don't know which way this thing will will go out. But I think that generally speaking, I would say that I think India is behaving very responsibly, and I believe that we will take any opportunity if the markets were to offer
Okay.
to actually add to our positions. And I think today India is in a far better economic position in terms of our FX reserves, in terms of our deficits. I think from a macro perspective, uh, we are in a far better position today. So any knee-jerk reaction that might happen because of any military intervention, I think would be used as an opportunity. And we can only hope that it doesn't spill over into a very prolonged war.
Interesting. Interesting. Apart from the geopolitical, Alok, I also know you follow macro numbers very closely. How is the macro looking to you currently?
Very interestingly, the macro numbers actually have started looking up. From the middle of last year, things started going downwards, wherein we had 4 straight months of single-digit growth in collections of GST, which is one of the better indicators for the overall economic activity. But now when we look, most of those indicators are coming back pretty nicely. To count them, the last month's GST number, the collections in April, they were at 12.6% growth year on year, which is highest since November 23.
Wow.
So that's a rebound.
Yes.
Our inflation is close to a 6-year low. The biggest variable, economic variable for India is crude, which we can't control much, and nearly 80-90% of our requirements is imported. Crude in rupee terms is close to 4-year lows. RBI has been most proactive. We saw how the deficit of more than 3 trillion rupees has been converted into a surplus of more than 2 trillion rupees. Our fiscal deficit is going to go back to pre-COVID times. So most of these indicators are coming back, not just on the growth front, but on the strength of the balance sheet front. And this serves well both on absolute basis and relative basis, primarily because of the uncertain nature of the geopolitics in the current scenario. So things are looking up. Good thing is that we are going into this kind of result season as well as the economic numbers with muted kind of an expectations, but numbers have started to look up.
Macros looking good. Structurally, India is very strong anyway. But on the earnings front, Hiren, this year seems like we would close with a single digit growth.
Correct.
How does the next year look to you? What's your view on the coming, say, 2 to 3 years in terms of earnings growth?
So I think after a fairly strong earnings trajectory post-COVID, where Nifty earnings literally compounded at 20% plus for about 4 years straight, we are now seeing some normalization that is setting in. And yes, this year we have seen a deceleration in economic growth. We all know, we talked about it in many of our previous communication, that the government was not able to spend the money on capex. There was elections. We were running a very tight fiscal and monetary policy until very recently. Now the monetary policy has become very clearly pro-growth, right? And it's only now that we are starting to see some lead indicators turn. But having said that, I think what usually happens is that once you start to see earnings slowing down and consensus estimates start getting cut, and once that happens, typically analysts become very conservative, right? So having said that, I would think that India could probably bounce back to early teen double digit kind of earnings growth. I don't think we are going back to those 20-25% earnings growth that we saw from, let's say, 20 to 24. That's not going to happen,
Sure.
right? And therefore, I think it becomes even more incumbent for active managers like us to find companies in our portfolio which can compound earnings at a much faster rate than this early teens that probably the Nifty earnings will grow at.
Absolutely.
So I think that yes, earnings are normalizing. Having said that, we have to wait and see because uh, some of the things could actually aid earnings in next year. Principal among them, as Alok mentioned, is crude oil prices,
Sure.
right?
Yes.
We've also seen other commodities becoming softer because there is this overwhelming feeling at this point in time that the US might slow down or go into a recession. Global growth might get impacted because of the tariff uncertainties. And we are starting to see softer commodity prices, principal among them being crude. And that could actually help or aid margins going forward for a lot of manufacturing companies. But we have to wait and see. I think we've seen from a low of almost 1.8% of GDP, corporate profits have rebounded to almost 5.5% of GDP.
Which is what we've been saying since
Correct.
in all our
And
videos.
the previous peak, as you know, in 2007-8 was almost, we had reached 7.5-8% of GDP. So I think we probably are in some kind of a consolidation phase after a very rapid improvement. But I think I'm quite hopeful that next year should be better than the year that has just gone by. Barring any other global upheavals or uncertainties or any geopolitical events which can drag for much longer. But if that were not to happen, I think we should have a better year in terms of growth and earnings uh, in at least in 25-26. And then I think we should restart our trajectory. Again, I don't think we go back to 2025, but can we do mid-teens? Quite possible.
Interesting. So, as active stock pickers, it's our duty to pick companies which give earnings growth better than the indexes. And that's what we kind of strive to.
Correct.
So, that brings us to the end of the market views this month. Markets have been volatile. It is a part of the market. There are uncertainties, but it is best to take advantage of these, especially for long-term investors. Stay with us while we stay invested in you. Thank you.